In this video, we will review an example of allocating and depreciating differences between implied and book values when the parent company uses the equity method of accounting. No lecture this time, just our examples.
In this example,
so let's get started. We have Porter Company purchasing an 80% interest in the capital stock of Salem Company for $850,000 on January 1st of 2013. At that time, Salem Company had capital stock of $550,000 and retained earnings of $80,000. Differences between the fair value and book values of the identifiable assets of Salem Company were as follows. So we have a difference in equipment, land, and inventory, and they all have fair values greater than their book values. The book values of all other assets and liabilities of Salem Company were equal to their fair values on January 1st of 2013. The equipment had a remaining life of 5 years on January 1st, 2013, and the inventory was sold in 2013. Salem Company's net income and dividends declared in 2013 and 2014 were as follows. So we have that information here. And they're going to ask us to do a number of things. First is preparing our computation and allocation of differences schedule. So again, remember this would be prepared on the date of acquisition. First thing we need is our ownership percentage. So we have that up here. That is 80%. Which leaves 20% for our non-controlling interest, and that last column is always 100%. Then we need to know our purchase price. So for our 80% interest, our parent company paid $850,000. So $850,000. In this one, they don't give us any information about the value of the non-controlling shares. So we're just going to estimate the total value of the entity by taking our purchase price and dividing by our ownership percentage, which gives us an implied value of $1,062,500. We're going to multiply that number by 20% to get the value of the non-controlling shares, which is $212,500. All right, then we need to figure out the book value of our subsidiary. They gave us that information up here. Remember, that's as of the date of acquisition. And so they told us that they had capital stock or common stock of $550,000 and retained earnings of $80,000. So we only have two equity accounts, so we're only going to have two equity accounts in our computation and allocation of differences schedule. First one is stock, which was $550,000. Second one is retained earnings, which was $80,000. Add those together. And we get a total book value of this entity of $630,000. Now our difference between implied and book will be our implied value minus our book value, which gives us a difference between implied and book of $432,700. Now we haven't done this in a while, but we now need to allocate our difference between implied and book, and we're going to allocate it first to any fair value adjustments, and then anything left over will be goodwill or our bargain purchase. So we're going to look up here for any evidence of fair value adjustments that need to be made. And we have three accounts that seem like suspects here. So they told us that these accounts have fair values greater than their book values and gave us the amounts. All three are asset accounts and all three are getting bigger. So that means that every allocation entry we make is going to be a debit to increase these assets. So we're going to enter all of these amounts as positive numbers. Remember that the number in here is going to be the difference between fair value and book value. So that's what they gave us. So we don't have to calculate anything. So equipment is going to get written up by $130,000. Land is going to get written up by $65,000. And inventory is going to get written up by $40,000. Now we're going to add these guys up. And, one more step here. We're actually going to take our difference between implied and book and subtract out all of those allocations. So now we have a remaining difference of our implied value over the fair value of the net assets. And so if we still paid more than the fair value of the net assets, then we know that that must be goodwill. So if this number had been negative, then we would have had ourselves a bargain purchase and we would have had to worry about a gain on allocation. We will get to an example of that a little bit down the road, perhaps. Otherwise, go back to one of our older examples. Okay, So now our computation and allocation of differences schedule is complete. So what we're going to do is we are going to put together our eliminating entries for our first year end. So again, remember, this is as of our date of acquisition. And now we've moved forward in time to the end of the first year that this consolidated entity has operated. So first thing we're going to do is eliminate any intercompany transactions. We don't have any, but again, I'm just going to have you guys work these steps every single time so that we remember that that's something we should keep an eye out for. Next, we need to eliminate any current year income of the subsidiary recorded by the parent or establish reciprocity. So the reciprocity is for the cost method, so we're not going to do that. This is equity method, so we know we would have recorded income during the year from the subsidiary, so we need to undo it. Now, in our previous equity method example, we did the general ledger entry, so we already knew how much income had been recorded. Here, we're going to have to figure it out so that we can undo it. There's also an extra twist here. Your book has been talking about the complete equity method and the partial equity method, but it hasn't really made a difference so far that we're ignoring one of them. Well, now it matters. So we're only going to do the complete equity method. And what the complete equity method means is that whenever the parent company records income from the subsidiary, they're going to take into account how much, or they're going to take account any adjustments due to fair value adjustments. So let me show you what that means. Our subsidiary reported income during the year of $100,000 even. That's up here. So we're going to put $100,000. Now, under the partial equity method, we would just trust them. And we know how to do the equity method. We would take our ownership percentage times this number, and we would report investment income. Under the complete equity method, we say, wait. We don't think that your income that you're reporting is 100% correct because we know about these fair value adjustments that are going to have an impact. So what we're going to do is we are going to put every fair value adjustment that we made in this table, and we're going to think through how it might impact net income of the subsidiary. So the adjustments we made were to increase the value of equipment, to increase the value of land, and to increase the value of inventory, and to establish goodwill. Okay, now we're going to think through each of these. So when does equipment impact our income statement? Well, it impacts our income statement when we sell it or when we depreciate it. So in this case, we didn't sell it, but we do need to depreciate it. So up here, they told us the equipment had a remaining life of 5 years. So our equipment, the subsidiary will have recorded some depreciation, but they don't know about this fair value adjustment that we made. So we say that the equipment is worth $130,000 more than what the subsidiary thinks it's worth. So the subsidiary isn't depreciating this amount. So we're going to need to do that for them when we record income from them and on our eliminating entries. So we're going to take this amount and divide by 5, and that's going to be our extra depreciation. So that's going to decrease net income. So I'm going to add that as a negative. Now, land impacts net income when we sell it. We don't depreciate it. So we didn't sell it and we don't depreciate it. So that one's fine. Inventory is going to impact our net income when we sell it, like in the lecture slides from last video. So they also told us that the inventory that was purchased was on the date of acquisition, or that existed on the date of acquisition, was sold during 2013. So we know that all of the inventory that goes with this fair value adjustment of $40,000 has been sold. So that means that that adjustment would also go through our income statement as cost of goods sold. So that means that we believe there's an extra $40,000 of cost of goods sold that our subsidiary doesn't know about. So when they report income to us, it's going to be missing that amount. So we're going to make that adjustment. All right, and then goodwill impacts our income statement when it's impaired. So we don't have any reason to believe goodwill is impaired, so we're good there. So we're going to add these guys up. And that gives us an adjusted subsidiary income of $34,000. So again, under the partial equity method, we would just trust them and say, okay, this is, they reported $100,000. Our ownership percentage is 80% of that. We're going to increase our investment in S and record equity income. But under the complete equity method, we're going to say, no, this is more accurate because as a consolidated entity, we have this extra depreciation. We have this extra cost of goods sold. So when we record our increase to our investment in S and our equity income, we're going to record 80% of this adjusted number that we know is better. And so that's what we did in this case. So when we need to undo that entry, we're going to decrease investment in S by the same amount it was increased during the year. And we are going to decrease equity income or equity in S income by the same amount that it was increased during the year. And that amount would be the $34,000 times our ownership percentage of 80%. Okay, next we are going to eliminate any current year dividends paid to the parent. So during the year, our subsidiary paid, up here, declared and paid $25,000 of dividends. So during the year, we would have received those as cash and we would have decreased our investment in S. So now we're going to increase our investment in S again. And our offset here is going to be on our subsidiary books. Remember, this is kind of a special intercompany transaction. That's going to be dividends declared by our subsidiary. And again, that was $25,000. Oops, 25,000 times 80%, because only 80% of those dividends came to us. The remaining 20% went to the non-controlling shareholders, which gives us an eliminating entry of $20,000. We still haven't gotten anything new here other than learning about how to eliminate subsidiary equity, subsidiary income under the equity method. Okay, this is our old trustee. This is the one we've been doing the longest. So I'm just going to pop our account names in here. We know we have investment in S. We also know we have two equity accounts, common stock of our subsidiary and 1/1 retained earnings of our subsidiary. We don't own 100%, so we must have a non-controlling interest. And we know we had a positive difference between implied and book at the end of the top half of our schedule. So we know our difference between implied and book will be a debit. Okay. Now, let's start with the numbers we know are always the same. Difference between implied and book is calculated on the date of acquisition and does not change. Common stock, our book is nice to us and it stays the same from our date of acquisition. So that'll be $550,000. Retained earnings will change over time, but the acquisition happened on 1/1 of this year. So our acquisition date and the 1/1 retained earnings are the same number. So our number in our computation and allocation of differences schedule is accurate in this case. And so since all of our debits match our computation and allocation of differences schedule, so will all of our credits. So investment in S is our initial investment of $850,000, and non-controlling interest is our initial balance of $212,500. Okay, and now for the last step before we really get to something new, which is our allocation of our difference between implied and book. So in the last entry, we debited it. So now we're going to credit it. For $432,500. Our computation and allocation of differences schedule is going to tell us where to allocate it. So remember, these are all debits because we entered them as positive numbers. So we're going to debit equipment, debit land, debit inventory, and debit goodwill because that's an asset we're creating as well. So we're going to take equipment, land, inventory, and goodwill, and we are going to write each of them up. We're going to write equipment up by $30,000. We're going to write land up by $65,000. we're going to write inventory up by $40,000, and we're going to write goodwill up by $197,500. All right, so now we have everything on the balance sheet, but we know that's not right because we know that we need to depreciate that equipment and we know that we sold the inventory. So we're going to go through each of these. I have them a little bit out of order here for no discernible reason. We'll start with equipment. So equipment, as we talked about when we were recording the income, is going to get depreciated over time. On our consolidated statement, any depreciation related to this $130,000 doesn't exist because we brought over the subsidiary's income statement and their income is based off of a depreciation number that doesn't include this fair value adjustment. So for any amount that should be depreciated this year, we are going to write down our equipment account. Now, this is because our equipment account is net. If you did the in-class activity, they had accumulated depreciation on the face of their balance sheet, so we used that account because it was available. In this case, they're saying equipment is presented net, so it's not going to be on the face of the financial statements, so we're going to depreciate equipment directly. Again, that was this $130,000 being depreciated over 5 years, so that's an annual amount of $26,000. That's going to go to depreciation expense to put that extra year's worth of depreciation for our fair value adjustment on the consolidated income statement. Next is land. Land, we didn't sell it, so we don't have to worry about that because we don't depreciate it. Inventory, we did sell, so we're going to back out this adjustment. Can't leave it on the balance sheet because that inventory isn't there anymore. And instead, we're going to put it to cost of goods sold because that's where the value of the inventory, the rest of the value of the inventory we wrote up has moved to. Then the last one is goodwill. Goodwill hasn't been impaired, so we don't have to worry about goodwill. We don't need to do anything with that one. Now, your book will take all of these and jam them into one entry, which I find to be extremely confusing. So that's why I've broken it up into multiple steps. I put everything into difference between implied and book first, no matter what year it is. I take that difference between implied and book and allocate it to our balance sheet accounts per the computation and allocation of differences schedule every year. And then I go through each one systematically and say, okay, is that still on the balance sheet or do I need to make an adjustment? And if I need to make an adjustment, I add another eliminating entry below this one to put it in the correct place. Our next example is just taking that same scenario we've been working on and moving it forward 1 year in time. So we have our same computation and allocation of differences schedule. It's a little bit more filled out than we did, but it's the same numbers because that's done as of the date of acquisition. And now all they want us to do is do our eliminating entries for the next year, for year end 2, assuming the use of the complete equity method. So again, we don't have any intercompany transactions. We do have income that the parent recorded from the subsidiary, so we're going to need to adjust that again. That was what we learned last time because of the complete equity method. So our initial income this time is $110,000. So we're going to start with 110. And we know we might need to adjust it for any of our fair value adjustments. So those were equipment, land, inventory, and goodwill. So equipment is being depreciated over 5 years. We're in year 2, so we're going to need to do that one again. So again, that was 130,000 divided by 5, and that's going to be extra depreciation, so it's going to be income decreasing. Land still wasn't sold and still doesn't get depreciated, so that one's fine. The inventory was sold last year, so it's not going to have an effect on this year's net income. And our goodwill still isn't impaired, so that's also not going to have an effect on this year's income. So our adjusted subsidiary income is $84,000. So during the year, we would have increased our investment in S by our share of this. So instead, in our eliminating entry, we are going to decrease our investment in S because we are undoing what was done there. And we would have recorded investment income. So we are going to decrease our investment income or equity in S income by the same amount. And again, that's going to be our adjusted income times our ownership percentage of 80%. All right, then next we have our dividends. So during the year, again, our subsidiary did pay dividends. So this year the dividend number was $35,000. Because we would have decreased our investment in S during the year, we are now going to increase our investment in S to undo this. And our credit, no matter which method we're using, is going to be dividends declared by our subsidiary. Again, that amount was $35,000. Our share is 80%. So we would have received $28,000 in dividends. So we need to eliminate $28,000 of dividends declared by our subsidiary. Then we are going to allocate or eliminate our subsidiary equity accounts. Again, I'm going to enter our account names first and then talk about amounts. So we have investment in S. We had 2 equity accounts, common stock, and 1 retained earnings. These are both of our subsidiary. I should have specified that. Then, because we don't own 100%, we have a non-controlling interest. And our difference between implied and book is positive. So our numbers that we know stay the same. Difference between implied and book is calculated on the date of acquisition and does not change. So that's still going to be $432,500. Our common stock is still going to be $550,000 just because our book is nice to us. But our retained earnings will have changed. So sometimes they give us the new 1 retained earnings. Other times we have to calculate it. This time we have to calculate it. So we know on the date of acquisition, it was $80,000. Since then, it would have increased when our subsidiary reported income. And we know our subsidiary reported income of $100,000 last year. And it would have decreased when our subsidiary declared dividends. And we know that our subsidiary declared dividends of $25,000 last year. So that gives us a new retained earnings that is incorrect because I left a 0 out of our income. If I fix that, it gives us a new retained earnings of $155,000. Because remember, we want it as of the beginning of this year, so we're not counting the subsidiary's income that they made during the current year. We're only counting it between the date of acquisition and the beginning of this year. All right, so now we need to do that thing where we take our increase in retained earnings and allocate it between our investment in S and our non-controlling interest. So what we're going to do is we're going to take our original investment in S, which was $850,000, add to it our share, or 80%, of the increase in retained earnings from between the beginning of the current year, which is in our eliminating entry, versus the date of acquisition, which is in our computation and allocation of differences schedule. We're going to do the same thing for our non-controlling interest. So we're going to take their original non-controlling interest, and we're going to add to that their share, or 20%, of that same increase in retained earnings. So the number that's in our current eliminating entry minus what it was on the date of acquisition, which is in our computation and allocation of differences schedule. Okay, so now we're going to allocate our difference between implied and book. And actually, this is going to be exactly the same as it was last year. So we're going to take our difference between implied and book. And we're going to allocate it to all the places that the computation and allocation of differences schedule says we should. So that's equipment, land, inventory, and goodwill. And we're going to put in the allocations that the computation and allocation of differences schedule says we should. So an increase of $130,000, an increase of $65,000, an increase of $40,000, and an increase of $197,500. But we know that these aren't right. We know that we've changed some of these. So we need to go through each one systematically and figure out how we need to adjust. So the equipment. The equipment, we depreciated it last year and we're still depreciating it this year. So we need to add depreciation expense to our current income statement. And we know that that's going to be in the amount of $130,000 spread over 5 years. But we also have some depreciation expense that happened last year. And so we need to figure out what to do with that amount. So overall, we've decreased our equipment by 2 years worth of depreciation expense, this year and last year. Last year's is going to get split between two accounts. Those two accounts are going to be non-controlling interest, and because it's the equity method, investment in S. So we're going to take 1 year's worth of depreciation expense times 80% and 1 year's worth times 20%. Now, next year, this amount will be the same because we want 1 year's worth on our income statement, but these two numbers will double because we will now have 2 years in the past. Once we get to year 6 and this is fully depreciated, this amount will be $130,000 and it will be split entirely between investment in S and non-controlling interest at an 80-20 split. Okay, working our way through our allocations again. Land, we still haven't sold it and we still don't depreciate it because that's not GAAP, so we can leave that one be. Inventory was entirely sold last year, so we need to take that fair value adjustment off the balance sheet. And split it between investment in S and non-controlling interest because this was entirely in a prior year. We don't want to put any in cost of goods sold because it happened last year. We don't want it on this year's income statement. So that'll be 80% to the parent and 20% to our non-controlling interest. So this will be the same every year for the rest of time. So we can kind of star this one and say, just keep doing this. We never need to think about this again. We know that inventory has been fully depreciated and we can just leave it be. Someday, when our equipment is fully depreciated, our land is sold, our inventory is sold, and our goodwill is fully impaired, then we could actually just kind of star everything from down here and say, okay, do these every year. We don't even have to think about it anymore. But we would still have to make them in order to make sure our consolidation worked properly. This concludes our look at allocation and depreciation with the equity method. Don't forget to email your questions for a discussion.